Good evening, everyone, and welcome to tonight's MLA Productivity and Profitability webinar. Thank you for joining us this evening. And if you're joining us from fire-affected areas in northern New South Wales or southern Queensland, just know that we have been thinking of you. And if you need anything, please reach out to us. So tonight we're joined by Matt Dalgleish from Mikado. And he will be taking us through the Australian beef market and what it's going to look like going into 2020, taking all things into consideration. So this, just a few things, a bit of housekeeping to get started with. You should be able to hear us, but we cannot hear you. The control panel that you can see on the screen right now should be at the top right corner of your screen. The red arrow at the top left of the control panel collapses and reinstates it, so you could get a better view of the presentation. Please type any questions that you have for Matt in the question box provided, and we'll attend to them at the end of the session. I will read these to Matt and he will relay the answer. So please make them as succinct as possible so we can get a good comprehensive answer for you. So as I said, tonight we are joined by Matt Dalgleish of Mikado. Matt works with Mikado as their market analyst and wool and livestock trading manager. Prior to joining Mikado, Matt began his career in 1993 with ANZ Bank as a technical analyst for foreign currency and interest rate markets. Matt progressed onto the currency trading desk both in Australia and London. In 2012, he decided to move his family to a hobby farm on the outskirts of Ballarat, where he could pursue a more rural lifestyle. Matt holds a bachelor's degree in economics and finance from RMIT and a postgraduate degree in education from Monash University. He's also the owner of a commercial piggery near Bendigo. So to present to us tonight, I introduce Matt Dalgleish, and I'll just swap over so we can see Matt. There we are. You're right to go, Matt. Everything looks good.
Yeah, I'm all good, and I presume you can hear me okay, Hilary?
Sounds good, yep.
Alrighty-o. Well, thanks for having us. Mikado, just want to extend our thanks both to MLA and to Holmes and Sackett for getting us to present tonight, and welcome everyone that's listening in. Just got a couple of quick details there just regarding me. Feel free to drop us a line at Mikado, or if you're not already familiar with Mikado, jump on the website and have a look. There's plenty of information on there across cattle and sheep and grains and wool, so covering quite a bit of the Australian commodity space. We'll start off right into it with a look at where we sit with regards to supply for the Australian cattle herd, and the most recent figures coming from the MLA October update to the cattle market projections. So you can see that for 2020, we are going to have the herd dropping to the lowest point that we've seen since the mid-90s. So you can see this dip down to here where I'm highlighting now with the pointer. Yeah, so lowest herd numbers we've seen, obviously in a reaction to the conditions we've been seeing, particularly in New South Wales and Queensland over the last year or so, with the dry spell and the amount of turn-off we've been experiencing. We just progress now and have a look at the updates to slaughter. So on this chart, we've got what the official figures are, and then there's the details from what MLA were forecasting in their August update in grey, and overlaid in October, that most recent update to the MLA slaughter forecast number. So you see they've revised up for the 2019 year. We're going up from 8.1 million head to 8.4 million head for slaughter. 2020 stays the same. It's 6.9 million head, but you can see that they've wiped away effectively what they've put forward to 2019 to a degree nearly. They've wiped away the slaughter figures for 2021. So we're actually going to see slaughter for 2021 down to 6.8 million head, and that's the lowest slaughter has been on an annual basis since 1989, which has implications, obviously, for price in those two periods with the low levels of supply that we're about to experience into next season. And I'll go into that in a little bit further detail as we progress through the slides. One of the key statistics we focus on at Mercado fairly regularly, at least on a monthly basis when the data comes to us from the ABS, is the female slaughter ratio. For those that aren't familiar with this particular ratio, it's simply the percentage of female cattle slaughtered within Australia as a proportion of total slaughter per month. And so we look at it to see what's happening underlying to the supply, and particularly we look at it with relation to assessing what's happening with herd liquidation or herd rebuild. When we're looking at this cattle slaughter, 47% is the threshold between when we determine whether the herd's in rebuild or in liquidation mode. Now this season, you can see 2019. Oh, before I go, I'll explain quickly what this chart shows, because we show these charts quite a bit on Mercado. So it's a seasonal chart, shows you the move through the year. The dotted line is the 10-year average, and the grey area, which we call the 70% range, is what we consider to be fairly normal based on the historic movement in this price or this indicator. So you can see, just for a guide, the 2018 season started out where we were at the early part of the season. We were still actually in herd rebuild mode, but as 2018 began to dry out to the middle of the season, we started to pick up and we were destocking pretty much all the way from about April through to December of 2018, and to a degree it was a similar type destocking event that we saw back in 2014. So I've got the blue line in there just to give you an idea of where that was. This 2019 season, we've just seen it really go off the charts, and particularly through the autumn and winter, with successive months up at 58%, was just the highest it's ever been, and certainly a sustained period, and it just indicated how dry it was in parts of the country and people turning off cattle, and particularly female cattle. We'll just take a look at another method of assessing this female slaughter ratio, and what we've got here is the orange line is the 12-month rolling average. So you can kind of see how this FSR, or female slaughter ratio, has behaved in previous seasons, and if you compare where we are this year now, you can just see how extremely high the female cattle slaughter has been for 2019. And if you contrast it back on an annual basis, it's the highest, or it's higher now than what we saw back in 1998, which was when we got to 52.1% as an annual average, and at 56.2 is what we're sitting at now. So we're pretty much clear 4 percentage points above the all-time high from previous records. So just gives you a real indication as to the extent of the female slaughter. And obviously we can see there as well, with what's overlaid on the chart, the change to the herd. So you can see what I mean, that 47%, if you look across and compare, and I'll do it with the pointer here, times where we've when we've gone above that 47% threshold, we start to see declines in the herd, and certainly over the last few years it's become very pronounced. So if we're below 47% through that 2011, after the good weather we saw in 2010-11, we saw the slaughter ratio decline below 47%. We saw this rebuild to the herd. Obviously the dry patch through 14-15 and the decline in the herd. We had a little bit of rain 16-17 when the restockers got really active, but obviously in the last year and a half or so, we've seen it really take off, and thus the forecast for 2019 is for about a 7.3% decline in the herd for this season. Turning to another measure we've got in beef industry is the processor margin. So this is a theoretical margin that's constructed to get an idea as to the amount of dollars per head per animal process that processors are enjoying. I suspect now at the moment you can see where the margin is. It's they're having a reasonably good time, and that's not unsurprising in dry seasons, they do tend to perform better, particularly in the situation like we're seeing now, where export prices are quite high on the back of African swine fever and what's happening over in the US markets. So if we just look initially at this chart, again, it's showing a similar scenario where we've got the long-term average margin that's made per month is around $40, which is the black dotted line, $40 profit per head. And then the grey area shows where the margins fluctuated for 70% of the time. So that's effectively what's considered a normal range between that grey zone, and that's from about a minus $50 or a negative $50 a head cost to a $140 profit would be considered within the normal range. And then you see those red dotted lines, or what we start to say is when you get beyond those levels, it's quite extreme. So you can see back in that 2014 period, when we saw the prices in the US for beef prices skyrocketing and the 9SL following that. At that stage, we were going through a significant turn-off in animals, so the cattle price in Australia was quite depressed, and processors had a big demand coming out of the US and really good prices. So, in fact, during this period, the US became our biggest destination for our beef exports for about a year and a half, through 14-15. And so the processors were able to enjoy low prices at the Australia here and very high prices overseas, and incredible demand from the US. So they made some good money through that period. This period now, we're again above what's considered normal, but we're below what's extreme. So at the moment, the average for the season for processor margins are around $190 a head is their average profit they're making at the moment per animal processed. I'll just show you a similar look so you can see, again, at one of those seasonal patterns. So you can see pretty much for most of the 2019 season, they've been experiencing above average margins, above that grey shaded area. And again, contrasting it to that 2014 season, you can see it's not too dissimilar in the first half of the year, but certainly in the latter part of 2014, when the demand from the US really ramped up and prices took off on beef exports, they made quite a good margin, did the processors. This season, we aren't seeing quite that extreme increases, although they're still comfortably above what's considered normal. For the next couple of months to the end of the year, we are forecasting the margin to continue to increase a bit. We have seen in the last few weeks the 9SL, which is a key driver of beef export prices overseas, that's really taken off again to a new level, and we think in the next month or so we're going to start to see those really strong prices feed into the margin for processors, and so they're probably likely to have a reasonably good finish to the end of this year. However, it's not all good news. If I turn to this next chart that shows the relationship between the processor margins on an annual average basis and the annual level of female slaughter, you can see there's a fairly high degree of correlation between what's happening here locally with supply, and that's largely driven by whether it's dry or wet, and what's happening with regards to rebuild or destocking of the herd. And there's a strong relationship with that and the processor margin. I've just highlighted a few key years as well. So if you can see this pointed down in 2017, we were coming off the back of that quite wet 16-17 period. Restockers were still quite active, so cattle prices at the sale yard were reasonably high, and there was fairly low levels of slaughter because of the herd rebuild. We saw the margin push into negative territory for that year. Contrast that with the dryness of 2019. We're back up at the other end of the spectrum, where we've got very high slaughter levels of female cattle, or cattle in general, but including females, as we've seen from the high female slaughter ratio. So high slaughter levels, and obviously that translates to quite good margin for the processors. Just for reference, over here at the top of the chart was the 2015 season, and that was 2014 there. So you see when those dry periods, you do tend to see really good margins for processors, as opposed to the wetter seasons where you see them struggling a bit, particularly if we go into a significant herd rebuild. So looking at the forecast for slaughter for next season, we've got two potentials there of a if we remain dry or if we go to a wet season, and that's largely determining on whether we continue to slaughter female cattle at the rate we're seeing currently. If we still stay around that 56% female slaughter ratio, high female slaughter proportions, it's likely that that'd be because the conditions remain dry into 2020. And based off MLA's forecast of 6.9 million head of total slaughter, they'd project that the processors are likely to make on average around $60 profit per head for the year 2020. Conversely, though, if we do turn to more of a wet situation and a situation that mirrored that 2016-17 period when there's an incentive to rebuild the herd and restockers come back into the market in a big way, we could see that impact the processors negatively. So you're looking then at female cattle being retained, obviously through that herd rebuild phase, and that's going to mean that the margins, if it goes to a wet 2020, that it's more likely the processors could turn to making negative, a period of negative margins for next season. So pretty much the range could be anywhere within there. So softer margins are projected for processors into 2020 either way. It just depends on the climate as to whether it goes into stays in positives or whether it goes into negatives. So I'll just turn to one of the developing situations that you may have been aware of. It's been pretty much all over the news of recent times with regards to the African swine fever, and certainly part of the reason why we're seeing these very strong export prices at the moment, not just for cattle, but for also other meat commodities, the appetite for China. So African swine fever is a DNA-based virus, because it's a DNA-based virus, it's very hard to kill. The issue with this African swine fever is it can stay active and within the environment. It doesn't need to have a living host that it's living inside of. It can remain in dust and dirt and on clothes. It can be retained in product, particularly pork product can hold, frozen pork product can hold the virus for up to 3 years, and it can remain active within that product. And in terms of a cooking temperature, it can actually remain alive up to 100 degrees cooking temperature. So it's got a fairly wide range that it can remain and persist within the environment, and that's part of the reason why it's quite difficult to eradicate. The mortality rate for pigs with this virus is over 80 to 90%. Of infected pigs will die within 7 to 10 days, so it's quite quick acting. And very hard to eradicate. As it stands now, there is no vaccine for the virus, and the graphic I've just been showing you as I've been chatting has been the spread of the virus across China since it was first detected in August of 2018. So it's pretty much all over China now and heading its way into some of the other Asian countries such as the Philippines and Timor-Leste and Burma and Myanmar, Vietnam, Cambodia. So it's pretty much the swine herd or the pig herd within Asia. It's infected about 94% of it's within countries that contain 94% of the pork herd in Asia. So significant issues. One thing to recall, to know with this virus is it's not harmful to humans, but certainly it's very problematic to the Chinese pork industry, and that's started having implications there. I'll switch across now to part of what's been happening because of this swine fever. Just in this year alone, in 2019, the Chinese government, well, they were slow to come out officially and let people know the extent of the problems they were having within their pork sector. But just recently they come out and admitted that they have seen 120 million pigs that are dead or been culled on account of the virus, and a 35% drop in their breeder herd over there. Now that's significant because the Chinese diet's heavily favoured towards pork meat, and because of the issues with the productions, well, they've got the biggest pork herd in the world at around 440 million head of pig. And most of the pig that is in China is obviously eaten domestically. So with the issues of their sector that's been experiencing this year, they're likely to have, by the end of this year, a gap in their pork production of 20 million tonne. And to put that into perspective, the entire Australian beef production in 1 year is 2.3 million tonnes. So they've got a gap in their protein requirements of nearly 10 times our beef industry. So a significant amount of protein that they need to find. And part of what we've been seeing, certainly for Australia, since the start of the year, is a significant growth in Chinese demand for our beef product. And that's this chart I've just got up now, which shows the monthly flows of beef for the last 3 years. And you can see, if you compare the 2019 orange monthly volumes to the dotted line, which is the 5-year trend, we're significantly above that. Indeed, I think we're about 122% above the 5-year trend in terms of flows this year. And that kind of growth in demand from China for beef is not just reserved for the beef market. The Australian mutton market's 118% above the 5-year trend. The lamb market's 69% above the 5-year trend. So there's an insatiable appetite at the moment in China for any form of protein, and from all parts of the world. So they're increasing their protein intake from New Zealand, and that's part of what's driving up the 90CL in the US as the New Zealand product and the Australian product's being sucked into China, and it's not making its way across to the US. And so the US are finding that they're having a bit of difficulty for their grinding manufactured beef they often get from Australia and New Zealand. It's taking a load of chickens out of Brazil and other beef product out of South America. All of those countries like Argentina, Uruguay, Brazil that send beef and other proteins into China are experiencing record levels of demand. So it's not just Australia that's experiencing it, but it's having a big impact on our beef sector. If we just look and see at the market share for our big four customer bases in terms of our beef exports from Australia to overseas, if you look back to 2017, China was sitting around 11% of our market share of our beef exports. 2018 they were at 14%, just below South Korea, who was in third place. At the start of this year, China was still in fourth place in terms of their overall flows, but within this year alone, they've gone from fourth place up to rivaling second place. They're now sitting at 23% of market share of Australian beef exports. Japan in number one spot is at 24%. So if they keep going for the next 2 months at the level they've been going, it's likely that they could hit top spot by the end of this year. So I'll just go to the 90CL, and I've spoken about that a few times, but the 90CL, for those that don't know, is just the 90% chemical lean. So it's the main product that gets in terms of manufactured or grinding beef that goes from Australia into the US and from New Zealand into the US. So it's a key ingredient that goes into their burgers. So it's a huge export indicator for us in terms of prices. And the Eastern Young Cattle indicator, as you can see by this chart, tends to follow the 90CL, generally speaking, fairly closely. There are times like we saw in 2014-15 where a big gap was opened up between the 90CL and the ECI, and that was because of that drought we were experiencing locally and the demand that was coming out of the US at that time, because they were just going through the beginnings of their herd rebuild. There wasn't enough product locally to satisfy their demand domestically, so they were importing a lot of Australian beef, and at the time, Australian beef was quite cheap because we were in the middle of the drought. So if you fast forward to now, we're again experiencing significant drought over a lot of the country, and that's keeping cattle prices reasonably suppressed. Whereas the 90CL, because of partially because of the demand coming out of China and partially because of what's happening in terms of the supply dynamics in the US, has taken off. So just this week it hit 8.40 cents a kilo carcass weight, the 90CL, and again that gap is similar to what we saw opening up back before the cattle market rallied strongly when we got the rains in 2016. Just take a look at this next chart that shows a similar pattern, and it's the relationship of the spread between the ECI and the 90CL. So the spread in cents per kilo is down the side here, and we're looking at the ratio between that spread and what we're doing domestically with regards to cattle slaughter within Australia. So you can see there's a reasonable relationship there in terms of more cattle slaughtered, and the spread goes to a bigger discount. So these are those periods that are dry back in 2014-15, and then when we move to the wetter period, and the spread can then sometimes go to a premium for a short period of time. Like in 2016, we got to about a 50-cent premium of the Eckie above the 90CL. So what we can do, we can see here we are this year at the moment, a dry season again with the spread significantly widened. However, should we get a return to a more normal season, you'd expect this spread to drift back up to this area. What we can do though, with those low slaughter figures forecast from MLA next year, if you remember that was 6.9 head of slaughter, that would, at that level of slaughter, the relationship would suggest that the Eckie to 90CL in a normal scenario could go to a 50-cent premium. And when I say a normal scenario, I mean if we're not in such a significant dry period and destocking, that's where you'd expect the spread to sit. So if you take that on board, and if you remember, I just said a minute ago that the 90CL was sitting above 800 cents at 840. Technically speaking, for next season, if we go to a reasonably normal season, it wouldn't be uncommon to suggest that we could see an Eckie up into the high 800s based on this relationship. So it takes us to our forecast model. So our Mercado model has a range of factors that go into it to determine what the annual average price is for the Eckie. So we're looking at the annual average, and what I've got there also is a shaded area that can denote what the likely range could be around that average, given the normal seasonal peaks and troughs we see in the beef market within Australia in any given year. So if we look at a normal season, before I go into the actual forecast numbers, I guess I should outline that this model takes into account where the Aussie dollar is trading, the supply ratio between the US and Australia in terms of production. It takes into account some global cattle prices based off USDA forecasts, and it has a climate factor involved, obviously, in terms of rainfall, and it looks at feed costs as well. So there's a whole lot of inputs that go into this particular model, and then it spits out what it suggests is the likely annual average Eckie based on all those inputs. And you can see by the chart, the green line is what the model's saying it should be, and the orange line is what it actually was. So it's not too bad in terms of being able to predict, and gives us a really good idea as to what the fair value should be on any given year. So for next season, 2020, if we have just a fairly standard normal season in terms of rainfall, the model suggests we could see the Eckie at an annual average of 600 cents, with a potential range of 470 to 750 cents during the year. What we can do though is overlay what would happen if we go into a much wetter season, and to the type of activity we saw back in 16-17 when restockers became quite active. And if I adjust the model for a wet season forecast, we can see that the annual average increases to 690 cents. And that would then mean that the potential range for the Eckie under a wetter scenario would be, according to the model, would be from 550 cents to 865. So now we're starting to talk about those levels into the high 800s, potentially even low 900s if we get a real spike beyond the model, which is not uncommon sometimes. And certainly with the developments of what's happening within China and ASF, there's still some way to go yet before the Chinese herd, the pig herd, is totally to its lowest point. The forecasts are that we won't see the worst of it until next year, the end of next year. So potentially we could see a scenario where demand from China continues to stay very strong. And if we get a wet season, then the restocker activity comes back into the market. So it could be a perfect storm to a degree for processors, certainly, that we've got very strong export prices and very strong prices at the sale yard because of the amount of activity if we return back into a rebuild for young cattle. If we just have a look, we've got a similar type model. It looks at the national heavy steer. So same scenario. It has some of the inputs to this model are slightly different. It's still got an Aussie dollar input. Still looks at a measure of slaughter and the herd ratio, herd size, and global cattle prices and a feed price into it. Heavy steer prices aren't as rainfall sensitive. Obviously, at that stage in their cycle, they're not likely at the heavy steer level to continue to put on more and more weight. So they're not as responsive as young cattle or store cattle are to rainfall. So the rainfall aspect isn't in this particular model. But what is important in this one is again, those very low slaughter levels that we're expecting for next year in 2020 at 6.9 million slaughter and 6.8 for the following year in 2020 means that supply for finished cattle is going to be quite tight, and then that's going to mean higher prices for finished stock as well. So higher than what we've seen this season is what we're forecasting for next year. So the annual average for heavy cattle next year, we're looking at an annual average of 5.90 cents with a potential range of 4.75 to 7.10, and that's a carcass weight price. And that's pretty much it for me, covering off on the cattle market. Ready to field some questions. Just before I go to that, if those that aren't aware, Mercado put out a Commodity Conversations, a short podcast, which you can find that on your normal places you go to find podcasts. Just look in for Commodity Conversations. We do a short version, which is a 10-minute wrap-up of the markets, and we do a longer version, one every fortnight or so, with guest speakers talking about issues that might be affecting the agriculture markets that are important to you. Back to you. Thanks, Hilary.
Great, thanks, Matt. I'll definitely be logging onto those podcasts. That sounds like a really great platform. Thanks for that really informative presentation. It was great to also touch on the impacts of the swine fever. We do have Andrew Whitelaw, also from Mercado, coming on in the next fortnight to look into impacts of the swine fever on the broader protein market. So look out for the material marketing on that webinar. We'd love to have you join us for those who want to know more about the impacts of the swine fever. But in the meantime, next week we have Wayne Pitchford coming on from the University of Adelaide, and he is going to be talking about beef selection traits. So again, look out for the marketing on that one. That's going to be a really cracking webinar. Just if you do have to head off quickly at the end of this webinar, you will close out the webinar and be presented with a survey. Could you please take 2 to 5 minutes just to fill out this survey? It's a great way, great feedback for Home Sackett and MLA and also Matt to just understand how the presentation went tonight, how the delivery was, and if we're hitting the right notes with what sort of information that you're after. So please take the time to fill out this survey if you do have to head off. All right, so please send through your questions now. I'll start reading out the first few that we've got. So please write them in the question box, and I'll read them out to Matt, who will relay the answer. So Matt, first question we got from a couple of people relating to the female slaughter data that you had at the beginning of the presentation. They were just wondering, is the drop-off due to the liquidation of the dairy herds?
Not really. Obviously, we have seen, certainly through 2016, we saw a little bit of that, but when you look at the overall size of the dairy herd from the perspective of the broader cattle market, they're not significant numbers enough to really impact to the level we've been seeing now. So those really high numbers we've seen this season are more a dynamic of the very dry conditions, focused in on New South Wales and Queensland, than more so than the dairy space.
All right. Thanks, Matt. So just keep your questions coming, guys, if you've got one. So, Matt, I see I've just got a question here. On where you were talking about the 90 cell and the ECI and the 2020 forecast, if we've had if we are lucky enough, fingers crossed, to get an average season. Just wondering, so 2016 was a bit of a record year, and the variability on the 2020 is not looking too different. Is that on the higher end of the market? Have we seen something like this before, if we do get an average season, or is it a bit of an unknown territory?
No, it's so if you look back to that 2016 year, as an annual average basis, the EYCI was about 6.30 cents over the whole year is what it averaged. But during the winter peak, when the restockers were quite active and when we normally get that rally in cattle prices, the EYCI got to 7.25 cents. And at that time, the 90 CL was 5.55. Which kind of, for a brief period of time, the EYCI went to, what's that, about 180 cent premium to the EYCI went to the 90 CL to a premium. However, it only happened for about a month or so, and then the EYCI started to come off again. So what we're looking at in terms of that chart I showed you that had the distribution between, like, might be able to actually.
Yeah, you can flick back.
Yep. So that chart there, during that year, you can see that 2016 year, even though in October we saw the premium widen out to about 180 cents of the EYCI above the 90 CL, when you looked at the whole of the 2016 year, the actual average premium spread was 50 cents. So you do have some variability there. And you can get times where the EYCI will go to a significantly higher premium above, during that year. And that's certainly what we saw in 2016, and what drove that rally. And I think you can see the rally actually here. It's that rally there when the EYCI went to 7.25, and the 90 CL was at about 555 cents or thereabouts. Obviously, the EYCI then came off as we headed into the end of the year, and the 90 CL rallied again, or other way around, I should have said. That was the 90 CL. That was the EYCI at 7.25, and your 90 CL there at 5.55. But they did, towards the end of the year, they did come back to pretty close levels, and that's when that spread tightened up again. If you look at it for this season, and if we recall that forecast model, so this particular one says that over the whole of the year, the spread could average 50 cents. However, at any given time during the season, you might have that spread widen out even further in terms of the EYCI going much, much higher than the 90 CL. Now, if the 90, I don't think the 90 CL is going to remain up at 8.40 cents, but certainly there's no reason why you couldn't see a 90 CL into next year, say into the 700s or low 700s, and then an EYCI that, if we get a wetter season, 50 to 100 cents or 150 cents above that, depending on the circumstances, is where we could easily see the EYCI heading up into that mid 800 level. It's certainly on the cards, and from the perspective of historics, that's definitely an unprecedented level for the EYCI.
Fantastic. Fingers crossed then. Just a question from Mick, who said, thanks for the great presentation, Matt. What are your competing origin suppliers such as Argentina, Brazil, Canada, etc., ability to fill the void like? Can it be done? I assume this is in
relation to ASF?
Yes, I'm thinking. Yep.
Yeah, I guess it is. And this is one of the things that I think people really need to understand in terms of what's happening in China. It's been a bit of a slow burn given when the virus was first discovered, and obviously it took some time for the Chinese government to come out and admit to the scale of what was happening. But from a global protein perspective, there's probably not one country in its entirety, or even a group of countries that probably has enough product in terms of export product to be able to send to China to really properly fill the void. We're talking about a significant gap in protein. Certainly, we are seeing our competitor countries in South America are equally sending a lot of product to China as we speak now. But the scale of this void is unprecedented, and I think the unknown from a forecasting perspective, and a lot of the modelling I showed you tonight doesn't really take into account the potential of what ASF might do to the global protein market space. We're starting to see some of it impacting our beef exports, but from an economic modelling perspective, we probably need to see a little bit more in terms of exactly how the dynamics playing out and how it's impacting price. So the current modelling is probably, from that perspective, it could be showing a bottom level scenario. The potential for higher prices is maybe still there. It's just that at this stage, with the modelling, you only can do a certain amount with the data that's available, and because this ASF scenario is very much in its early stages, and we're still from time to time we still have to wait till we get official word from China. So some of the forecasts and expectations for how it's going to impact China into next year, some of that's still I guess it's a bit speculative to a degree. Because the Chinese government have been so careful about what they release. But we do know of how this virus has impacted previous countries, and we know that it's a serious virus and it's hard to contain. So it's going to be something that's going to take. It's going to be more than just next year. Next year is when we're going to see probably the depth of the Chinese decline in their herd and the biggest protein gap. But some estimates of the gap in protein could expand out to 35 million tonnes of missing product. And so it's not going to be something that can be easily fixed. And indeed, if there's no vaccine or a cure found for this particular virus, there's no reason why, if China starts to try and rebuild their pork herd into the end of next year or 2021 or 22, there's no reason why the virus can't come back again and have a second wave. So it really means that they've got to change the whole of their nature of their pork industry. And the pork sector in China is very different to Australia and some of the Western European countries, in that a lot of it's smaller operations, specialised operations that have a herd size of less than 1,000. I think about 85% of the Chinese pork industry has farms that are less than 1,000 head, which from a pork sector they're small farms. But with those small farms means that it's much less biosecurity. They still engage in spool feeding over there. And so what we're talking about is a massive adjustment to what has to be done in China to make them not be impacted by this ASF virus in future times. And so that means it's going to take more than just next year. You're probably looking at potentially 5 to 10 years for the Chinese to actually redesign their pork sector. And there are some commentators out there saying that they think that they'll never be able to get back to where they were. I think that's a bit extreme. Certainly, the Chinese government has showed historically anything that when they set their mind to something, they're pretty good at achieving it. But it's not going to be a simple fix, and it's not going to be solved in 2 or 3 years' time. It's going to be something that's going to, I think, take at a minimum 5 years and potentially 10 years before they get back to a level of where they were prior to this virus outbreak. And so what we're seeing this year, what we're going to see into the next season and coming seasons is a very big change to the global dynamic to how protein and meat product is traded around the world.
Oh, fascinating. Watch this space. So Nick has just sent through a question. Does the Australia versus US dollar have an impact that you can talk us through?
Yes, it does for both. So the forecast models that I put up for the ECI and the National Heavy Steer both have an Aussie dollar component to it. As a rough rule of thumb for both of those, they're not exactly the same, but just I don't have the numbers are not at my fingertips, but pretty much you can say as a general rule, for every 1 cent fall in the Aussie dollar, so if the Aussie dollar goes from 77 US cents to 76 US cents, for every 1 cent fall, you generally the relationship is about a 5 cent per kilo carcass weight price addition to the price for the ECI and for the National Heavy Steer. So they're fairly similar relationships, but they're not quite exactly the same. I think the ECI is slightly more responsive and National Heavy Steer is slightly less responsive. I think the ECI might be 5.5 cent gain and National Heavy Steer might be 4.5 cent or 4.8 cent gain. But they both gain in that fashion when the Aussie goes down. And when the Aussie conversely goes up, then you do start to see where it impacts prices domestically the other way around. So a 1 cent higher increase in the Aussie dollar takes about 5 cents off the carcass weight price of both of those indexes.
Thanks, Matt. Question from Fiona. Will the anticipated high prices for cattle under a good season prevent mixed farming operations from re-entering into the beef industry, given that restocking will be at a significant cost? Does it force people to look at switching to enterprises with a quicker return, such as cropping or prime lambs?
That's a fantastic question. It's exactly one of the things we've discussed on we had a most recent Mercado commodity conversations talking about what happens after the drought. I think it was actually released this week, where myself and Andrew Whitelaw, our grains analyst, and Rob Herman, who's experienced across all commodities, got on there and had a chat about what we think might happen, and that's exactly that. We're going to see, and when you were saying before, Hilary, about the higher prices are great things. They certainly are. But for people that need to get back into the market or want to, that have, they've seen their herd decline by 50% or more, that want to try and get back into the market by buying store cattle, they're going to find, or even PTIC, cows, that they're going to find the prices higher than what we saw during when the restockers were very active in the 2016 period. So it's not going to be cheap to get back in, definitely. I guess for those that are looking to get back in and then starting to shy away because of the high prices, one positive you can take out of it is that given what's happening with this ASF scenario in China, the likelihood of finished prices coming off in the near term is fairly slim as well. So you can be reasonably guaranteed that the prices for your product, once you've finished growing them out, will still have good value. But it's certainly not going to be cheap. And the alternatives, the thing is though, if you look at the situation for the sheep flock, they're in a similar scenario. It's not going to be cheap to get back in to buy breeding unit. I think just this week, ewes at the one of the New South Wales markets touched $400 a head. So they're seeing record prices for those animals, and certainly the incentive then to go back in and put some form of a cash crop in for a quicker return might be something that producers have to weigh up if they've got that as an option. It's going to certainly make for interesting times, but I think depending upon your business mix, and it's a time when if you aren't already heavily invested in chatting to good quality advisors to help you do the numbers on these options that you're going to have faced before you, now's the time to make sure you get yourself a good one, because they'll be worth their weight in gold if they can give you good advice and good numbers to work your budgets around and find out what's the best mix for your particular enterprise.
That's fantastic advice. Thanks, Matt. So that's all that we have for questions tonight. Thanks everyone for the questions. They were really great tonight. Thanks again, Matt, for coming on and presenting, and we look forward to having Andrew on in a few weeks' time. So thanks everyone for joining. Again, next week, Thursday night, 8 p.m, we have Wayne Pitchford on discussing beef selection traits. So thanks again, Matt, and good night, everyone.
No problems. Take care.